In this video, I'll be documenting my recent stock purchases as well as the monthly and all-time performance of my portfolio. My main focus with investing is to build passive income through dividends. My goal is to reach £4,000 per month in truly passive income. I currently invest within a stocks and shares ISA, which means that anything I make is 100% tax-free. Getting started with compound investing can be slow at first, but given enough time, the advantages of compounding can really start to kick in. Each time I invest, my dividend income increases and the so-called dividend snowball begins to gain a little more momentum. The way I look at it is time is going to pass no matter what, so why not take advantage of that by way of compound investing? My aim with this series is to be as transparent as possible with my investments and portfolio in general. I hope this will help others to see the realities of investing as well as the highs and lows along the way. I've been documenting my portfolio in detail since day one, so you can get a sense of how things progress over time in real world market conditions. Consider subscribing so you don't miss out on regular updates. The content of this video should not be taken as financial advice. I'm only sharing my own experiences. In ascending order now, from the worst to best performers in my portfolio this month. First off, the worst performer this month is Unilever in the consumer staples sector. Unilever is down 2% this month, but still up a solid 9.1% over the last 12. Unilever has a dividend yield of 3.7%, which is very reasonable. Although Unilever's growth has levelled off since 2019, I still believe this is an excellent stock to own and that it has a bright future ahead due to its sheer size and ability to buy up the competition, which creates what's known as an economic moat. GSK in the healthcare sector next, with almost no change since last month. Unfortunately, GSK has recently cut its dividend from 80 pence to 56 pence per share due to a demerger and some restructuring. Ultimately though, I think this is the right move for the company to make right now, and it will help the performance in the long run. Onto the Vanguard All World High Dividend Yield ETF, which is one of the two purchases that I made in January. I really like ETFs as they provide lots of diversification, which is especially true of this one, which contains a massive 1,814 different stocks. They also typically require less knowledge to pick out when compared to an individual company. VHYL grew by 1.9% in January, making it the first grower in my portfolio so far this month. VHYL pays a quarterly dividend of 3.5%. Next is the iShares Core FTSE 100 ETF, which mirrors the performance of the FTSE 100, which has been on a bit of a run since the lows in mid-October. This grind higher continued through January, which saw an increase of 3.2%. The rise brings the one-year total to 4%. The iShares Core FTSE 100 ETF pays a healthy dividend of 3.5% on a quarterly basis. National Grid next in the utilities sector is up 3.7% this month, however it's still down 5.9% on the year. National Grid offers a solid 5% dividend and a long history of reliable payments, as well as consistent dividend increases. Bluefield Solar is an investment fund that's involved with renewable energy. With many government targets aimed at reducing carbon emissions in place, renewable energy seems like a good place to invest over the long term. In addition to this, Bluefield Solar has a solid dividend of 5.9%. Bluefield Solar is up 3.7% this month, which brings its one-year gains to 13.7%. Tesco now in the consumer staples sector is up 7.4% and is my second best performer this month. Tesco currently has a dividend of 4.8%, which is paid out biannually. HSBC has rallied by a massive 12.5% this month due to a brighter outlook from China's reopening. HSBC was the second stock I purchased this month to help further diversify and get some exposure to the financial sector. Here you can see each individual stock's performance from best to worst in a nice, easy to read and more visual format. A clear contrast from last month when all but one stocks were in the red. Let's take a look at the performance of the sectors. This is based on the stocks I own in the sector and not the sector as a whole. Financials being the clear winner thanks to HSBC. On to sector weighting now. Currently consumer staples is the most dominant sector in my portfolio, but I'm sure soon enough ETFs will take over. I'll look to try and find something in a sector I don't yet have any exposure to next month. Tesco is currently the most dominant stock I own in terms of weighting. It's also my best overall performer with 16% growth since I bought it around 3 months ago. I generally like to invest around £500 at a time, which is why most of my stocks are fairly equally weighted right now. When I'm more diversified and own a few more stocks, I'll begin to increase the position size of my favourites, and the difference between them will be much larger. I did state last month that I plan to keep around 5% of my portfolio in cash so I can snap up a bargain when I see it. However, I got a little bit carried away with my stock purchases this month, so I currently only have around £17 cash in the account. This might not have been the smartest move, and I'll have to be a bit more disciplined going forward. This month I added a total of 985 to the account. I aim to add around 1,000 per month for the time being. The account gained £96 in real terms once you subtract the money that was added to the account. The portfolio's market value currently sits at 3,821. This, as well as the dividend tracker, is my favourite chart to look at, and it's now starting to feel like it's getting somewhere. The 5k mark will be a significant one for me in terms of morale. I'm hoping to reach that milestone by the next update. I finally received my first dividend of £8 this month from National Grid. However, my average monthly dividend works out to be £14 per month, based on my total yearly expected dividend income divided by 12. I don't actually have any dividends due in February, but there's 3 in March. I would like to have something come in every month because I find it more motivating, so I'll try and fix that soon. So far, the total return on investment of my portfolio is 4.7%, which I'm happy with as it's only been 3 months, but I did start investing during a pretty significant dip, which has helped. Here you can see how my portfolio's ROI fares up against a few popular indexes over the same time period. As you can see, I would have been better off simply putting everything into an index fund. However, due to timing, I've only received one of my smaller dividend payments to date, and had I been more fortunate with the ex-dividend dates, my return would have beaten that of the FTSE 100 by a small margin. As long as I'm at least keeping pace with the FTSE 100, then that's okay with me. If you found any value in this video, then consider liking and subscribing, as it will really help out with the algorithm at this early stage. If you do have any questions, please feel free to ask in the comments below. Check back soon for the next update, as well as my upcoming video on how to stay motivated when starting out as a compound or dividend investor.